How to know in advance where the market might reverse. Market movement is energy, and the ATR Zone indicator clearly shows how far the price can go during the day and where the market loses strength. Today, I'll show you how to use this tool and, most importantly, how easy it is to open trades with ATR Zone and avoid unnecessary losses. To understand how ATR Zone works, you first need to understand the basis, what the ATR is. ATR stands for Average True Range. It is one of the most popular volatility indicators. It shows how much the price moves on average over a selected period, for example, a day. This tool was developed by the famous trader Welles Wilder, and today it is built into almost all trading platforms, including MetaTrader. The main things ATR is used for are, firstly, volatility estimation. With its help, we can understand whether the market is active or not. Secondly, to determine the movement potential. ATR literally tells us the price can go this many points, no more. And thirdly, setting stop losses and take profits. It helps not to set targets and stops at random, but to rely on real market dynamics. ATR is like a navigator that shows how much fuel the market has left to move. Now you realize that ATR is a powerful tool. But there is one problem. The standard ATR is displayed as a bar chart below the chart, and for most traders, it doesn't give specific clues. It shows a numerical value, but does not answer the main question: where exactly on the chart the price can reverse? That's why I created ATR Zone, an indicator that takes this data and translates it into visual levels right on the chart. Now you can see exactly where the market is likely to lose strength and where a reversal is most likely to occur. Now I'll show you what the ATR Zone indicator is, so you can understand how it works. ATR Zone is not just a modified ATR. It is a full-fledged tool that builds key volatility levels based on the average daily price range. These levels are displayed directly on the chart, and this greatly simplifies the process of analysis. The first thing the indicator gives you is an understanding of the limits of daily movement. You can immediately see how far the price can go without overheating, and this already gives you a reference point where the movement can potentially end. Next is the most interesting part. ATR Zone helps to determine in which zones the market loses energy, and these are the points where pullbacks or reversals are most likely to occur. We will open trades exactly at such moments, but I will tell you about it a bit later. And of course, the third advantage is clear entry and exit points. You don't just see the levels, you observe the price reaction, and you can make decisions based on specific zones, not by eye. In developing the indicator, I used the methodology of Alexander Gerchik, which means that the average move over the last 5 days is taken into account in the calculation. An extremely large and too small candlesticks are excluded. This makes the levels more accurate, realistic, and adapted to the real market. Now let's understand exactly how ATR Zone levels work and why they are so important for understanding price behavior. On the chart, you will see 6 key levels. The first of them is the balance line. It is not just a line. It is a balance level, in other words, the opening price of the European session. It helps to understand who is controlling the market at the moment. If the price is higher, buyers hold the initiative. If it is lower, sellers dominate. The following 2 zones are calculated from this line: market upper limit and market lower limit. These are the boundaries of the daily range, beyond which the asset is most likely not to go. It is here that the price most often starts to lose energy, because the market has already passed its average daily move. And in most cases, either a stop or a pullback occurs from these limits. There are 2 more levels: high ATR and low ATR. Unlike the previous ones, they are built from the maximum and minimum of the current day. These levels show the possible extreme potential of price movement, if the impulse continues. This is a great clue as to where we can expect a slowdown and even a reversal. Finally, there are 2 levels that intraday traders especially appreciate: the 61.8% Fibonacci levels, or high Fibo and low Fibo. They are calculated on the basis of ATR and indicate the areas from which pullbacks are very frequent. This is where the market shows the first signs of impulse loss. And if you know how to read these zones, it becomes much easier to find profitable entry points. The most important thing you should understand is that the price stays inside these boundaries in most cases. Going outside is more of an exception, and it is most often associated with news or extreme movements. But under normal conditions, ATR Zone is a great indicator of where the market is running out of energy. Let's see how to use the ATR Zone in real trading. Here on the chart, the price has approached the marked level, This is an important boundary of the daily range, and we can already see the market starting to slow down. The candlesticks are getting smaller. This is the first sign that buyers and sellers are fighting for control here, and the price may turn around. Now we look further ahead. Price tests the level, but does not break through it. A reaction appears. Several candlesticks show a bounce. This gives us a confirmation. The market is not ready to move further in this direction. This is where we will look for an entry. There are two options for entering the trade. The first one is a conservative approach. We wait until the price touches the level and starts to slow down. As soon as reversal candlesticks appear, we enter the trade. This option gives more confidence that the level really works. The second is an aggressive approach. Here we immediately set a limit order on this level and just wait for the price to catch it. We do not wait for confirmation, but we get an entry with a better price. This method is suitable for those who are ready to take a little more risk. Where to place stop loss and take profit. Stop loss is placed behind the level from which we entered the trade. If we trade from the upper boundary, put the stop loss a little higher. If we trade from the lower boundary, a little lower. This allows us to exit the trade if the level doesn't work. Take profit can be placed on the nearest opposite level of the ATR zone. For example, if the entry was from the upper boundary of the daily range, the take profit can be set towards the balance line or the lower boundary. This gives us a clear target and a good risk to profit ratio. Now, let's see how the movement develops. The price bounces off the level and goes in our direction. Eventually, we reach take profit, and the trade closes with a profit. ATR Zone helps to find points where the market is likely to stop. All that remains is to choose a convenient entry option and follow the system. Now you know how the ATR Zone indicator works and how to use it to find strong entry points. The only thing left to figure out is how to get it. This indicator is available on the MQL5 website, where you can purchase it for $69. There you will also find a demo version, with which you can test it on history and see how it works out the levels. Some may say that $69 is expensive, but let's face it, how many trades have you opened without realizing where the market might stop? How many times has the price reversed, where you didn't expect it to? In trading, it is important to make informed decisions. It is better to invest once in a quality instrument than to lose much more on spontaneous and wrong trades. But remember, there is no magic button in trading. No indicator gives a 100% guarantee of profit. It is just a tool that helps you to see the market more clearly. Ultimately, success depends on you, on your discipline, proper risk management, and ability to follow a strategy. If this video was useful, please like it and subscribe to the channel.